Hello everybody and welcome to our discussion on stock replacement strategies with options. My name is Joe Cusick. I am with the Cusick Group and I want to welcome everybody on today's discussion. Now before I get started, I do want to go over some disclosures. Securities and investment advisory services are offered through AOS Inc., which does business as Trading Block and Money Block, a registered broker-dealer, FINRA, NFA, SIPC member, and a registered investment advisor. Now, options do involve risks and may not be suitable for all investors. Please read the characteristics and risks of standardized options. It's available at the optionsclearingcorp.com website or at the bottom of the Money Block website, where you can click on an icon and you can download that document. Now, any stock option or future symbol that are displayed are for illustrative purposes only and should not be intended to portray a recommendation to buy, sell, or hold any particular security. Now, AOS nor the Cusick Group provides tax or legal advice, does not provide tax or legal advice, and the content and tools that are provided for are for educational and informational purposes only. Products and services are intended for U.S. customers only and may not be available or offered in other jurisdictions. Now, today what we want to cover is utilizing options to replace long portfolios. Now, some of you might say, well, what about short positions? That's for another day. Today, what we want to do is we want to actually talk about how we can take our core long portfolio and start thinking about putting some of those names into utilizing option strategies that make sense as far as our risk tolerances, our objectives. Now, what we need to do in this presentation is define how the vehicles that we're going to utilize to accomplish that. And that's what we're going to do with the utilizing LEAPs, which are longer term options. We'll also talk about the impact of time decay and how your current experience, where you're most likely utilizing options that have a very short duration as far as expiration is concerned, those implications of time decay, those are much larger than what we're going to suggest strategically, which is using longer term options. And then we're going to talk about just not only building out the core portfolio using long call options that have a longer expiration date, but we're going to talk about strategic approaches that actually mitigate volatility risk, mitigate not completely, but to a good degree, premium risk and so forth. And then we'll walk through the what ifs of each scenario. So what the term LEAPS actually means is long-term equity anticipation securities. Now, LEAPS is a registered trademark of the Chicago Board Options Exchange. And the product was actually built many years ago because there was a need for options that went outside of the normal expiration cycle, which was usually around 9 months or less. The long or short of it is that you don't need anything to do with the LEAPS position as it gets within that 9-month period, but it was a product that was devised so that accounts like IRAs and individual accounts could actually use these longer term contracts without having to go in and negotiate a customized contract. And so it was very powerful, and it's grown enormously. Now, I want to get into the time decay factor because a lot of you on this webinar have gone to many, many different classes and learned about the impact of time decay on options. For premium sellers, that is your advantage. You're trying to get collect that every day. For premium buyers, or in other words, option buyers, that is what's working against you. Time's always ticking away. But the one thing that I want to talk about here is that you'll see from the graphic of a 1 day, 1 month, and 1 year, you're going to clearly see that there is not only a huge difference in how decay actually works as you get close to expiration, but you will also start to see and understand that time decay is not linear, which is the first bullet point. Buying a little bit more time doesn't mean that it's necessarily going to cost you that much more in terms of decay. As a matter of fact, you're going to start to see that the decay factor is negligible for longer term options. And really what you're doing is you're managing the premium risk outside of that, which is, how long before you're right on your convictions. In this case, if you're buying longer term options, how long does it take for that particular underlying to start move to the upside so that position is doing what you want it to do, which is ultimately capitally appreciating. Now, I'm not suggesting that there aren't times as far as buying options when you can or cannot use front month options, or options that have basically 90 days or less. You could utilize that strategy as a stock replacement strategy. It's a very short period strategy, and the conundrums that come up with having less time to be right is quite simply you have less time to be right. And quite often I have utilized and found through my experience that when I'm buying options, unless I'm buying them deep in the money on the short period of time, I found that it's very frustrating, and that I found that my probability of success and my success ratio has been much lower than the core strategy that we're going to talk about today, which is using longer term options or leap options. So let's actually look at the impact of time decay and just the general premium that's in an option when you start with something like along the lines of 1 month. You can see with an option that's deep in the money, and I'm going to look at the $35 strike over the next 10 months basically. So I'm going to look at the 1 month, the 2 month, the 4 month, and then the 9 month. In this example, you see that the 1 month option that's deep in the money, stock's trading at basically 41.35 that you can see from the stock price there on the right. You see all the other components in there as far as volatility, days to expiration, and interest rate. And the thing that you're battling right now is twofold. Couple things. One is that you always have that price risk, which is delta. But the one thing that we're focusing on is that our directional bias is to the upside. This option is basically decaying every day about 3/1 millionth of a cent. Now that doesn't seem like a lot, but as over the course of time, as you get close to expiration, that is actually going to ramp up. And right now there's 29 days left to expiration, or 30 days. 29 in this case. So that's going to start ramping up. And if the stock starts to pull back, that theta component is going to become even bigger. All right. So as in other words, if it goes from 41 down to 40 or 38, that option is going to start to decay at a greater amount. Now you see a little bit of an uptick in the 2 month option, but it's also more expensive because you have more time. As a matter of fact, you have almost twice as much time. And that's, in my mind, an advantage, because if the stock does pull back, yes, it's going to decay, and it might decay at a quicker rate on the 2 month option, and that's why I'm saying that you have to watch it in that first 90 days, and you're going to see this. That decay factor starts to kick in, especially for in-the-money options and out-of-the-money options. That's why I said earlier that time decay is not linear. But you can see that the premium is increased, and the real factor is that because there is more time for you to be potentially right, if you're buying this option, or even if you're selling it. So the bottom line is that the decay factor is still small, but it's there. And looking at the 4 month option, it is more expensive. And the obvious reason is that even though it's the same strike, you have more time to be right. So they're going to build that premium in there because of that time component. You see that the theta is actually a little bit less than that 2 month option that we saw. 5/1 millionth of a cent. That does start to add up, folks, especially as you get close to expiration, or the stock starts to move, especially on the downside. And then finally, we look at the option that's 9 months or greater. In this case, it's a little more than 9 months. And you can clearly see that the theta component is basically flatlined, that there is still some theta, but it's not getting smaller, it's not getting any bigger, and it gives you 246 days to be potentially right. But you see that the option's trading at $7.60+. This is a really important component, because the one thing is that you're seeing that the pricing is not the same for all options, even though they have the same strike price, because of the fact that you're extending out duration or time. Now, traders quite often look at that as something that they have to overcome. And we're going to talk about some strategic approaches to overcoming this, but let's look at the general concept of buying that long-term option. So let's look at the general leap strategy. Now, first and foremost, why are you actually deploying or implementing a leap strategy versus just holding the underlying asset outright? In other words, owning the stock. For example, let's say 6 months, a year, 2 years, 10 years ago, I bought 1,000 shares of USB. Now, I don't own it. This is an example, at $35, and it's currently trading at $41.40. Now, I still like the prospects of the shares, but I'm nervous about the market, interest rates, and the economy. The one thing is that you'll see right now with the stock basically trading at $41, you have over a $5,500 profit built into this position. Now you own 1,000 shares, so the total requirement, as you can see from the right, is pretty substantial. It's $41,000, $41,460. So with your concerns or nervousness about the current market, the interest rate markets, and the economy, which could impact this stock, which happens to be in the banking segment, you're sitting there going, okay, I want to reduce my capital risk. In other words, get it lower than 41,000. I still want to participate on the upside. And if in fact the market does start to fall apart, I know that I have limited risk. And so what you're going to look at is how do I do that, since my prospects for 2016 and this underlying, in other words, my overall thesis is I'm still bullish, and I'm also willing to accept the tax implications. And the only reason why I'm bringing up the tax implications is sometimes people put that up as a roadblock. Oh, I'm not going to sell this because it's short term. I'm going to take a big hit on the profits. I'm going to pay 43% in taxes. Yes, that is a big deal, and I don't want to minimize that. And I also don't want to say that it's not important to have a tax strategy. And as a matter of fact, you should have an accountant that has experience in doing accounting for options and derivative-based strategies, and talk to them, see what your tax strategy should be going through. But we're going to just basically walk through with the fact that, you know what, I understand that when I sell this stock, and I'm going to look at potentially utilizing leaps as a strategic approach to basically replace, or in other words, mirror a stock position that I was previously in, because I still have the same prospects. I understand the tax implications. Now, the mechanics of this are pretty straightforward if you're going to deploy it. You're going to sell your 1,000 shares of USB at $41.46. So that's going to be your profit, right? Then you're going to go in and you're going to look at options that are basically have an expiration of 9 months or more, and they go out as far as 24 months, so in other words 2 years. In this case, you're looking at buying 10 of the January 35 leap calls for $7.05. Now, what does that mean? That means that first of all, the price in which you are going to be long stock is $35. Now, you're paying a premium for that right. And you bought 10 contracts. And 10 contracts, because you're trying to simulate to not one for one, but to a great component, your past stock position, 10 contracts is equal to 1,000 shares. So if you exercise these 10 contracts, you're going to be long 1,000 shares. The price is going to be at $35. Now, you're paying a premium for that. In other words, you're paying a debit for that, and that's $7.35. Or in other words, you have $7,350 of risk capital working in this current position. Now, you can clearly see that that is your ultimate risk. So looking at that, or just thinking about that mental checklist, I said that I wanted to have limited risk. Well, $7,300 between now and January, the third week in January of 2017, that's all I have at risk. So if the stock goes to zero, I lose $7,300. The other thing is that you wanted to participate in future upside. As a matter of fact, you want to have as much viability as that as if you own the stock outright. Well, this gives you that unlimited profit potential, as you can see from the graphic. The trade-off is only until January of 2017. Okay. The third thing is that you freed up capital. As a matter of fact, and I know I have that as number 2, so I guess I should have gone in order. But that freed up capital because you have $7,300 of risk. You originally had $41,000 plus, and so now you have freed up $34,000 in risk capital that you can either deploy for other ideas. You can go out and utilize it because you need to pay off some debts, or you have another opportunity. So these are the mental checklist points that you want to have. And also, yes, you could say that those are advantages, but really that's what your goal was to make sure that you're mitigating capital risk, that you have still the profit potential that you potentially have, understanding that there is expiration, and you have excess capital that you can deploy. The potential risks are, well, bottom line is that you can lose the whole 7,300. Another thing that you have to look at is that unlike stock, when you buy it, for example, when I bought it at 35, again, as an example, once it goes to 35.01, I've made a profit. Now, when you purchase an option, it's the strike price, in this case 35, plus the premium you pay, which is 730, and that gives you your break-even point, in this case 42.30. So with the stock trading at $41 and some change, I still needed to go up around 60 or 70 cents before I'm at break-even. In other words, it means that the option's basically trading penny for penny with the stock once it gets through the break-even point. And then the last thing is that the two last trade-offs are that you have $7,300 of risk capital out there. So it's not like you just own it for free, which technically with the $5,200 or $5,300 of profit, you own over 2/3 of it outright. You know, in other words, if you take your profits from your stock portfolio, so really you could theoretically say that you have only about $1,400 worth, or excuse me, about $2,000 worth of risk. Again, that's just another thing that you can weigh out the trade-offs. The other couple things that I want to mention is that if you were receiving any dividends when you own the stock, you are no longer going to receive the dividends. Also, if there are any voting situations that come up, I know a lot of you haven't probably participated in executing your own voting rights, but that's something that you're going to give up by deploying this strategy. So if that's something that is important to you, and so then you may not want to utilize this particular approach. So now that we understand the mechanics of actually taking a look at some of our core holdings that we want to replace with these longer term options, which gives us anywhere between 9 to 24 months until they expire, or in other words, to stay in there with less capital risk, obviously understanding the trade-offs that we mentioned. The one thing that I haven't discussed is, and this is, I think, the biggest part of your job as an investor and a trader, is that you need to mitigate that capital risk that you have in that current option strategy. And how do you do that? I mean, you can't receive dividends, so that doesn't reduce your cost basis or mitigate that. How do you do that? Well, let's talk about some strategic approaches. One thing that you want to look at, and a lot of people would say, well, wait, hold on. I know you have limited risk when you buy these options and you have time on your side, but why don't I just buy a put option? Well, you can. It's called a married put. So as a matter of fact, a stock can get married. You have that theoretical unlimited profit potential or gain potential. And the flip side of that is that you have limited risk through the lifetime of that put. In other words, until the expiration of the put. Now, when you do that, all you're doing is taking a longer term put that's saying, I want to floor myself out. In this example, I'm using a 20, I think the stock was trading right around 35 and some change. And so I want to basically cap myself off as far as risk, or bottom myself out at $23. That was my original purchase price. So I pay 40 cents for an option that's basically going to be around for about a year. Now, that one option will basically set a floor at $23. Well, actually, the actual floor is at $22. If I pay 40 cents, $22.60. So for every 100 shares that I own, if the stock were to go through $22.60, I would no longer be losing any money. Now, to me, I have two problems with that. The first problem that I have is that that for every one lot that I have out there, I still have, or for every 100 shares that I have out there, I still am tying up $3,538. Yes, buying the $23 put, as you can see, gives me a floor, but I'm also doing one other thing. which is I'm adding risk capital. I know it seems nominal at 40 cents or $40 per contract, but the point being is, and remember, go over that mental checklist. I wanted to reduce some of that exposure to the market as far as owning stock outright. So I have $3,500 of exposure. That might be a little too much with what I'm nervous about in the current marketplace. The other thing is that I want to mitigate my risk capital exposure, not add to it, and that $40 adds to it as well. So it's not completely meeting what I need. But for those of you that want to understand it, yes, and you would ask the question, can I use puts to hedge my stock portfolio? Yes, you can. It just, the cost benefits aren't what I want to do as a trader, an investor, and as a manager. Now, instead, with the stock trading at $35, what I want to do is I want to replace the stock with a long-term option. Once I've done that, I've now checking off that box that I've mitigated some of that original $3,500 worth of risk capital out there. And by buying a $23 leap call option that's going to expire, in this case in 10 months, I have now mitigated that cost down to, instead of having $3,500, I have $1,300 per contract, as you can see from the graphic, the table on the right, as well as the graphic here. Now, the option is made up of two components, intrinsic and time value. And time value is what you are battling. This is what we want to mitigate right off the bat as far as the risk capital or risk component or component of the option that you want to manage. And some of you might say, well, how can I do that? Well, think of it in terms of a covered call, or what we call a diagonal. Again, welcome to the world of vernacular here in the options world. Now, I'm going to sell one April $37 call, and I am going to do that for 50 cents. Now, that 50 cents, if in fact the stock between when I established that position, and we're going to say that was in March, so in other words, it's right around 45 days out until expiration, I sell that option. If between March and April expiration, which is the third week, if the stock stays below or goes to $37, I collect that 50 cents. That means that it will decay, and I keep that, and that offsets that time premium. Now, you have the right to do this against your long option. It basically every month. So I'm going to roll this option. Now, you might ask, what are some risk management techniques that you use with this front month option that you're selling against your leap? Well, the first one is that I'm going to be selling an option that basically has a probability of being in the money at expiration, no more than 30% probability. Some of you might say, well, how do you determine that? Look at the delta of the option you're selling. If it has a 30 delta or greater, you're going to have two things potentially happen. One is that you have a higher probability that the stock is actually going to test that level. So in other words, if the $37 call had a 40 delta, that means that basically you have about an 80% probability of it potentially touching or testing that $37 level. That might make you a little nervous. But you'll see from the graphic to the right, that payoff diagram, that really what you're looking at is what some have called it looks like a covered call, right? But then some have called this diagonal a poor man's covered call, because you're using the longer term option that's deep in the money. And I say deep, that option that I'm buying, one other little note or nugget is that option that I'm buying usually has no less than a 70 delta. I'm usually looking in that 70-80 delta range. And so that option I'm selling, again, probably in that no more than 30, but it's most likely not going to be any less than 10 delta, because it's just the premium that I'm getting on those far out of the money options just isn't worth it. And you will continue this process until either A, you see that the market is doing exactly what you want to do, and you don't want to write any premium against it because it's moving up, and especially if you see it moving up aggressively. And the other thing is that if you keep doing this, you're actually mitigating, or in other words, offsetting your cost basis by the amount of premium that you take in every month. That is a huge component of this. All right. Now, for those of you that say, Joe, I don't want to go through the mechanics. I'm new to this. I'm just looking at something where I said, you know what? I'm replacing my stock purchase of $23 with this leap that's going to be expiring in 9, 10, 12, or 24 months. That I'm willing to pay that premium for having that right to own the stock, in this case at the $23 level. And that means that I'm willing to risk $1,300. Now, I like the idea, Joe, of offsetting my cost basis of that $1,380, but I also don't believe that the stock, which is currently trading around $35 and some change right now, will get much over $40 between now and January of that expiration year, of the following expiration year. So in that case, I could tell you, well, look at, again, the 20 to 25 delta call that's in the same expiration month of the leap that you're purchasing. And you sell that, in this case, $40 call. You receive the $2.40. That offsets your purchase price of that $23 call. So you now have a 10-month vertical call spread or a bull call spread on, and you paid $11 and some change, right? And so you're paying $11.40. Your break-even point is $34.40, which, by the way, is now lower than where the current stock's trading. So this spread is in the money. Your potential profit is at expiration. So in other words, you got to stick around for quite a long time before you're going to recognize profit. If the stock goes up, if you establish this position today and the stock goes up tomorrow to $37, you're going to have a small profit, but it's not going to be as great if you were using the diagonal or if you were just long the outright leap on its own. That's the trade-off with this particular strategy is that you really are going to have to wait until you get close to or right at that January expiration period, and you're going to need the stock close to, right at, or above $40 for you to recognize that full potential gain of $5.60. But to put that in context, if you look at this individual position and the return, and in fact you were correct on your thesis that the stock is at or above $40 by January expiration, that $1,140 that you put out there as risk capital is now basically trading for 17, which means that you have a $5.60 profit on the risk capital you put out there, or a 49% annualized return on the investment of $1,140. That is spectacular. And also remember, more importantly, is something that probably statistically is not going to happen, because remember, at the time you sold that $40 call, and this was part of your thesis, there was less than a 40% probability of touching that level. Again, I determined that by looking at the original delta, which is it only had a 20% probability of being in the money. Okay. Now we have a probability calculator that's available to all of us, whether you're at the Cusick Group or if you come to Money Block or Trading Block. The firm has some pretty cool tools that you can check out and look at, and those tools actually do the probability of an option or of a stock being above or below a certain level, and that's actually provided by their partners at TradeSpoon. So let's go over some of the challenges, some of the opportunities with this strategy, and then we will open it up for questions. So consider commissions, dividends, and voting rights. If those are things that you always have to keep in the back of your mind, and keep it part of when you're looking at this strategic approach, that all those are considered and it fits your risk tolerance objectives and goals. All options decay over time, even leap options, but leaps are going to decay more slowly than options that have 30 days, 60 days, or 90 days. Not every stock has leaps, so keep that in mind. Also, leaps have fewer strike select prices than shorter term options. That's just a function of time, right? The bid-ask spreads on leap options, those longer term options, are quite often larger than the shorter term options and the stock outright. And also remember, when you look at the example, the premium that was collected in example 2, in other words, where I diagonalized, where I sold the April 37 call versus the January $23 call to collect that premium, offset that time decay, as well as just overall capital risk and that ownership, while understanding that I'm going to give up or cap myself out between now and that April expiration at $37 as far as potential profits, that is a taxable event. So in other words, if I did that in 2014, I would have a short-term tax implication, either profit or loss, depending upon whether the market stayed below or went above that strike price. And again, consult your tax expert on that. And we've covered most of these, summarized most of these risks. There is risk in buying leaps. You can lose the potential total premium, but that was one of the trade-offs because you mitigated the risk of owning stock outright. That's a larger amount of money that you have to have up. So that, you know, again, that was something, that was a trade-off that you were willing to accept. There is risk with buying time diagonal spreads and vertical call spreads. Again, you could lose the whole potential debit, but I said the term debit. That means that you own something against what you're short, and so that's very important. And so that those are completely offset. All options decay over time, but may move a little bit more slowly, especially with the longer term options versus the shorter term options. And then the tax implications with replacement. And then no stock strategy should solely be done on tax basis. It just doesn't make any sense to me. It should be acknowledged. You should understand it. You should have your tax expert explain it to you. And always consider commissions, especially if you're going to start utilizing strategies like selling options against core long strategies. There are going to be multiple commissions. You're going to have to make adjustments. You're going to have to do rolls and things of that nature. So there are going to be probably more transaction costs than just a buy and hold. Okay, and then the number of LEAP products has mushroomed over the years, but again, not every product has, not every underlying has LEAPs. Also, there are a variety of other strategies that you can utilize with LEAP options and short-term options and so forth. So just keep your horizons and your mind open when you're thinking about this. There are a lot of flexibilities to this. And always consider the risks and challenges of using long-term options. Now, I hope this has been a very informational and helpful discussion, especially as we get into the time of year when people are at their portfolios, and then they'll say, well, I'll come back and look at it in the fall, or I'll look at it, you know, later in the year. And this is where you need to just look at it today, and you can start looking at some of those core holdings that are doing well, especially if you're starting to get nervous or you have a circumstance where you want to still continue to participate in the upside of the market with your core portfolio, but you need capital for something. This is a great opportunity to look at this strategic approach. Now, the benefits that I can offer you as far as my services are that you can, if you want to jump aboard and talk to me about developing a relationship here as an advisor, you can talk to me directly, be it via phone or email, and I am licensed to be an investment and portfolio advisor. I will also offer the opportunity to everybody that's listening to this presentation to have a free portfolio review. So if you have a current core portfolio or you are in the process of building one and you want to understand what are the risk components that, does this fit my risk tolerance and objectives? It feels right, but really what is it? Is this an aggressive portfolio or is it an income with modest growth? And who am I as far as an investor and a trader? And how does that fit into my long-term goals of retirement? I can do that for absolutely no cost, and I really enjoy doing that. So if you are interested, you can always email me at jcusick, jcusick@moneyblock.com. It's at the bottom of the screen right here. And of course, if you have any questions, you can email me there as well. All right, everybody, I want to thank you very much for being on today, and we'll talk to you very soon. Have a great rest of the trading day and trading week. Take care.